Hello, everybody. Mark Gilmore here with Kestrel Advisors. It's currently June 6th, 2023, and updated home price information was just released last week. It was a bit of a surprise to see the strength of the uptick in the home price data, and I, for one, was frankly quite surprised. However, we still believe at Kestrel Advisors that the housing market is in a correction phase. We're able to see the strength of the surge in that recent uptake in the housing market in this graph, in the very last data point here. That appears to be quite a significant uptick. However, despite the seeming strength in the market, we at Kestrel Advisors still believe the market is in correction mode and will continue to fall further from here. Now, the behavior of the market right now does contrast with its behavior in 2006 after the market peaked and then began to decline. Whereas here we're seeing an upsurge in the market in this cycle, the spring cycle. Back in 2006, early 2007, we did not see a similar kind of upsurge in the spring housing cycle. And bear in mind that the spring cycle in the housing market is typically the strongest part of the annual housing market cycle. But let's take a little closer look at each of these two housing bubbles in the national market. On this spreadsheet, I've taken the liberty of color coding a few important data points on a couple of the charts here so that we can see more easily some of the key characteristics of the behavior of the housing market during this spring housing cycle. Now, this graph here depicts the bubble in 2006. The yellow data points here represent January of 2006 and 2007. The orange data points represent February of 2006, 2007. And the red data points, of course, represent March of 2006, 2007. Now, what we can see here visually is that year over year, the prices increased between January from 2006 to 2007. February, they were roughly equal. And in March, they actually began to decline year over year. On a month over month basis, we see that in 2006, they were increasing each month. In 2007, however, they were declining month after month after month. But overall, we see that this market peaked and then just began to decline. There was no subsequent uptick. If we contrast that with our current market bubble, we can see here, again, we've got the January data points depicted in yellow, February data points depicted in orange, and the March data points depicted in red, that we clearly have year-over-year increase in the January data points, the February data points, and even the March data points. But in contrast to 2006, there is certainly a month-over-month increase throughout 2022. And in 2023, we also see a month-over-month increase. But even though the charts don't give us a clear indication, if we look at the underlying data, that provides a little additional information for us. So let's go ahead and take a look at the data right now. We see, and this data is from the 2006 housing bubble era. The data here, right here, is from 2007, early 2007. In this column, we have a calculation that shows the year-over-year increase in prices in the national housing market. What we see here is that home prices year over year are on a declining trend each month. However, and this column shows the month over month increases in the home price data. In contrast to the year over year data, the month over month data shows an increase in strength. even though in each case the monthly values are lower than they were during the previous month. The overall, the comparative strength of the month over month data is increasing. Now, if we skip from there down, this is again 2006. If we skip from 2006 down to our current housing bubble, went a little too far, we see something quite similar. On a year over year basis, the comparative strength from month to month is declining. For January, we see that compared to a year earlier, the year over year increase was roughly 3.75%. That then declined significantly to just about 2%. And from there, for March, year over year, has declined to roughly 2/3%. However, at the same time, we see the month over month data is increasing. So from January to February, month over month, we've increased from negative 0.62 to 0.32. That's almost a 1% increase comparatively, month over month. And then again, from January to February, we go from 0.32 to 1.26, also an increase of almost 1%. Now, interestingly, we have seen this before, not at the national level, but in some of the specific MSA level markets, some of the city specific markets, and has often been said history does not repeat itself, but it often rhymes. Now, that's frequently attributed to Mark Twain, but research indicates that it was probably a German psychologist or philosopher, Theodor Reich, who coined that phrase. Mark Twain himself is attributed with something similar. His quote, which is unequivocally attributed to him in writing, is that history never repeats itself, but the kaleidoscopic combinations of the pictured present often seem to be constructed out of the broken fragments of antique legends. That is much more poetic than the quote that we frequently use. But as I mentioned, the quote that we use cannot be reliably attributed to Mark Twain. But that is the second one is his actual quote. His actual quote. But apart from that digression, let us return to the housing market. As I mentioned, we have seen this kind of a pattern before, and it reinforces our belief at Kestrel Advisors that although there's been a recent uptick, a resurgence in the home price data in the national housing market, that market is still in correction phase, and we do continue to expect to see home prices decline further from here. So let's take a closer look at that pattern in some of those city specific markets. We can start with the Boston housing market, where home prices reached their peak in the middle of 2005 and then began to decline. So we can see here some year over year data, year over year comparisons, and month over month comparisons for the home price data in early 2006. Now, what we observe here, this column shows the year over year data. We see a significant decline in home values on a year over year basis, beginning at 0.87%, declining drastically from there to just plus 0.09%, and then turning negative to negative 0.23% and negative 0.47% the month after that. Again, that's on a year over year basis. That's comparing, January of 2006 against January of 2005, February of 2006 against February of 2005, March of 2006 against March of 2005, and April of 2006 against April of 2005. Now let's contrast that with the month over month data. We see here that on a month-over-month basis, home prices appear to be surging. From December to January, home prices fell almost 1%. However, from January to February, they gained a lot of ground. They were still negative, but they gained approximately 0.75% month over month, from negative 0.96 to negative 0.22. From there, they turned positive between February and March, going from negative 0.22 to plus or positive 0.47. Again, an increase of roughly 0.75%, that's 0.69%. Who's counting the details? And then from there, they surged again from March to April, increasing from 0.47% to 0.72%. So we see a very similar trend here as we're seeing in the national housing market right now, where on a year-over-year basis, home prices are in decline, yet on a month-over-month basis, they're ascendant, on the ascension. It seems quite contradictory as a logical concept, but perhaps it will help to visualize it a little bit. So we can actually see that trend visualized in this chart here. Now, on a year-over-year basis, we see the data points depicted in yellow representing January. We can see that there's some increase from January to January. The data points for February here are depicted in orange. Again, and it's hard to tell visually, but there's some increase on a year-over-year basis. Now, the data points for March we see depicted in red, and it may or may not be clear, but there's actually a decline on a year-over-year basis from this data point to that data point. What we can see clearly, though, is that here we've got an increase on a month-over-month basis. Here it seems to be a decline from January to February on a month-over-month basis, but then we tick upwards and have an increase on a month-over-month basis from February to March. However, as we can begin to see in this graph here, even though there was an uptick on a month-over-month basis and we saw a surge through part of the year, home prices then began their decline again, both on a month-over-month basis and a year-over-year basis. We can compare the remaining data points here for 2006 against those from 2005, and visually it's quite obvious that they're all lower on a year-over-year basis than they were as compared to the 2005 year. Now, let's take a look at that in a little more detail. This graph here depicts the Boston market during the bubble formation years. Hi, honey. Sorry, my little Foster pit bull is just nuzzling up against me, wanting a little bit of attention. So, of course, I have to give it to her. She's a sweetie, but she needs to find a home. So what we see here is from 2002, early 2002, through middle of 2005, home prices were increasing rapidly. Now, in 2005, the home prices in Boston did reach a peak and then began to decline. At the end of this graph shows the data we were just looking at in a little closer detail. I know. And it shows that beginning uptick in home prices on a month-over-month basis at the beginning of 2006. However, as we saw in the prior chart, even though there was a little uptick in a month on the month-over-month basis, ultimately, in a year-over-year basis, home prices continued to decline. Now, this subsequent chart here shows the severe nature of that decline over the ensuing several years. Even though home prices did continue to tick upwards on a month-over-month basis, they could not sustain that momentum. And ultimately, the year-over-year declines in those home prices, as we compare the home prices year over year, dictated where the housing market was going. Ultimately, the Boston market lost approximately, I think it was 25% of its value from peak before it began to staunch its correction and turn upwards again. Now we see similar behavior in the Charlotte housing market. Again, this column represents the year-over-year home price increases, and this column here represents the month-over-month home price increases. Now, Charlotte didn't reach its peak until sometime in 2007. So we're looking at data from the beginning of 2008. But what we see here again is a similar pattern, where on a year-over-year basis, home prices were on the decline. As of January 2008, home prices had increased about 2.5% from the prior year. But comparing February to February, we see that decline to about 1.8%, a decline of roughly 0.7%. From there, we see an additional decline when we compare the March to March numbers. They increased only 1.1%. And when we compare the April numbers, they increased only roughly 0.5% year over year. At the same time, though, on a month-over-month basis, home prices were increasing, going from negative 0.5% to just about even, negative 0.08%, and then entering into positive territory at plus 0.25%, and then almost doubling to roughly 0.5%. Again, we can visualize that in a graph. Now we see here with the January data points coded in yellow, on a year-over-year basis, they're clearly higher. And with respect to February, also clearly higher. And with regard to March, again, clearly higher. As well, on a month-over-month basis for the year of 2007, we see them increasing. I should note here that while on a year-over-year basis, the data points are higher, we do see that the strength of that increase is decreasing. We can see that the difference between the yellow data points is clearly much stronger than the difference between the red data points. That's the difference between the January data points and the March data points. So we can actually visualize that the strength of that increase on a year-over-year basis decreasing in this chart right here. And as we look at the additional data for the Charlotte market, this graph depicts the home price bubble inflating. When we look further, we see that following that differential in the data that we just examined between 2007 and 2008, the housing market continued on a declining trajectory for the next several years. So when we observe this pattern of home price increases declining on a year-over-year basis, even though they're increasing on a month-over-month basis, the consistent result appears to be that the housing market in question will continue on a declining trajectory over the next subsequent period of time to come. In the mid-2000s, it was for a period of several years to come. The particular chronological dynamics of the market appear to be adjusting, so it may be a shorter time frame this time around, but nevertheless, the consistent observed pattern appears to be that the home prices continue to decline over some period of time to follow. Now, again, according to our analyses at Kestrel Advisors, We believe that period of time will be roughly 1 year from this point in time. We believe it may be up to 13 months from the data that we are observing now. In other words, we believe that as of the data that represents May of 2024, the housing market may reach its bottom uh, in the correction cycle for the national housing market. So, what does that mean? Well, it means that we expect the national housing market to fall about approximately 25% further from where it is today. In other words, we expect that the market may continue to tick upwards a little bit on a month over month basis. Yes, honey, you're moving the table. From here, yet ultimately it will decline over the next roughly 12 or 13 months to return to the trajectory of our fair valuation curve. That means that home prices on an aggregate national basis or a collective national basis will decline roughly approximately 25% from where they are now. We can show a different graph that may help to put it into a little better perspective. Now, this is mostly the same data, but just gives a little bit longer view of the housing market. This one reaching from 1997 through the present. So, as you can see here, that would constitute a significant correction to home price values in many markets around the country. Again, though, each metropolitan area is unique and has its own specific characteristics. Some are wildly overvalued at this time. Others, while they may be overvalued, are only very, very modestly overvalued. And we wouldn't expect to see significant decreases in home price values in those only modestly overvalued markets. And we do track a number of different markets here at Kestrel Advisors and have curves that are specific to each one of those individual markets so that we can identify those that are substantially overvalued, in which home prices are likely to crash harder, versus those that are only very modestly overvalued, where we expect home prices to remain, if not roughly the same, only slightly lower than they are at present. I do hope you've enjoyed this additional presentation from Kestrel Advisors, and please tune in again next time for more keen insights from Kestrel Advisors.